Everyone, welcome today to the Local Government Pension Scheme Power Hour. My name is Jamie Callaghan. I work in the Education Skills Funding Agency, and I'm your host today. So we'll move on to talk through some of the domestics first, and then I'll introduce the other speakers, and then we'll get cracking with the presentation. Just before I go through the housekeeping, I'm sure you'll all have heard there was quite an announcement yesterday that a general election's been called. So we've decided to go ahead with the presentation today, but we just want to stress that we do need to focus solely on local government pension scheme here, and we can answer questions on factual and technical questions on LGPS, but we ask that only those questions around LGPS are asked rather than more general questions that may have been in your minds following the announcement yesterday. So if you use the chat function to ask any general questions for the Q&A session, which we'll come back to at the end, we were unable to answer questions specific to a trust. More general questions we're happy to answer. And we may not publish all questions asked, referencing the announcement yesterday as well. So we'll try and focus on LGPS questions. There's also a tell us how we did survey at the end, and we'd very much like you to feedback for us. Thank you. So to introduce myself again, Jamie Callaghan, I'm the head of LGPS operational policy, and welcome back to anyone who joined our previous LGPS Power Hour. A couple of my colleagues on the call today, Jenny Mulrooney and Ross Calbraith, and they're in the background and will be helping us to answer questions live. Welcome back as well to Charity Main and Richard Lane, who are the chair and vice chair of our working group that focuses on LGPS. Charity is the chief operating officer from Anglian Learning, and Richard is the director of finance and operations at Twyford Church of England Academies, and they sector representatives on our working groups focusing on LGPS. And welcome today as well to Simon Taylor and Rob Bilton, who are also members of our working group for sector engagement group. Simon's joining us today from West Midlands Pension Fund as a pension fund manager. He's not representing West Midlands, but rather the pension fund community within LGPS. And Rob is joining us today from Hyman Robertsons, who's one of the 4 actuaries that operate in LGPS. And again, Rob's not representing Hyman's itself, but a representative of the actuaries that operate in the sector. So very warm welcome, especially to Simon and Rob, to help us talk through some of the technical aspects of LGPS as we move on. Just going to quickly talk through the agenda today. So we've got an action-packed agenda, hopefully. So we're going to talk through some basics of the valuation, and Rob's going to help us understand that with his actuary hat on. And then moving on to the market update and the current outlook for 2025. Simon's then going to talk to us about the employer engagement that a pension fund would do and the various aspects of that in terms of how it engages with the academy sector. And then a little bit about funding valuations and accounting valuations, which I'm sure many of you will have come across those different concepts. And then we're going to move across to Richard, who's going to talk to us about the recently published best practice guidance on LGPS that we've published and is being produced in conjunction with Working Group 4 as well. So that's hopefully a best practice guide that will help you as practitioners within the academy sector. And then Charity's going to come back and just update on some feedback and guidance in terms of the engagement. And then returning back to me for a Q&A session at the end. So please do drop your questions about LGPS in the chat function, and then we'll try and manage those at the end, and I'll direct them to the relevant person. So without further ado, I shall pass over to Rob.
Thanks very much, Jamie, and good afternoon, everyone. So I'm just going to spend the next 15 minutes or so just talking about valuation basics and also what the current market context is and what that may mean for the next upcoming valuation in the LGPS as at March 2025. So just start with the basics first. If we just move on to the next slide, please. Really, just at a high level, I think it's important to remind ourselves and understand about how the LGPS is funded, so the local government pension scheme. It is rather unique in the sphere of public service pension schemes in that it's funded And what that means is essentially an LGPS fund operates that money is paid into the fund. It collects money from employers and employees, so the contributions that are paid in. That money is then invested. So the LGPS is funded. It has a pot of assets, and at the moment, sort of nationwide, that ranges from anywhere between 350 to about 400 billion pounds. So that money is invested, and the idea is that money over time, those contributions grow along with investment returns, and then at the point then there's enough money there to pay out members benefits. So that's what we mean by it's funded. We'll have the pot of assets, there, and that's different from the other major public service pension schemes, such as the teachers' pension scheme, where they are unfunded in nature. So what happens there is employer and employee pay money in for the teachers' pension scheme into government, and then that money is effectively paid straight back out to members and benefits. And if there's an excess of contributions above benefits, then that money just falls into government's general revenue and income. And if there's a shortfall, then the shortfall is covered again by government's income and revenue. So because we're funded, that means that every 3 years, the LGPS fund needs to carry out a formal valuation, what we'll call a triennial valuation. And if we just go on to the next slide, we'll just cover why a valuation is needed. So as I mentioned, these valuations are carried out once every 3 years, and that's in line with the legislation that governs the LGPS, the Local Government Pension Scheme. And in England and Wales, every LGPS fund is every LGPS fund's valuation is carried out at the same date. So the last one is at 31st of March 2022, and the next one is at 31st of March 2025. And I've got listed here some of the main reasons why the valuation is carried out. For yourselves as academy schools and as participating employers in an LGPS fund, the main reason for yourselves and the main interest that you'll have is that the valuation then sets the contribution rates that will be payable by employers over the next 3 years. So the upcoming 2025 valuations, those will set contribution rates payable from 1st of April 2026 to 31st of March 2029. Okay, and part of the other elements is the valuation. It's a really important risk management exercise for LGPS funds. So it's an opportunity for them to take a step back and look at their funding strategy, look at the investment strategy, the plans they have in place to make sure they've got enough money to pay members benefits. And because the environment within which these LGPS funds operate, with the financial, the demographic and the social environment change and frequently change, check that they're appropriate, and if they need to make any tweaks or changes to the funding plans. And then they'll communicate those changes as well, because they may have an impact on employer contribution rates with employers themselves. So that's the main reasons why we do evaluation. How evaluation is carried out is discussed on the next slide here. And again, very high level here, but essentially the funds have 12 months to carry out the valuation. So the regulations say that the valuation has to be completed and signed off by the following 31st of March. So for the 2025 valuation, we need to have it all done and dusted by the 31st of March 2026. And evaluation is carried out very much thinking about it simple. We have a set of inputs. So an LGPS fund will provide data about each and every individual member in the pension scheme to the actuary. Every LGPS fund has an actuary, what's typically referred to as a funds actuary, and the fund actuary will take that data along with a set of assumptions about what the future may hold, such as what will future inflation may be, how long do we think members will live for in the longer term. Take that information along with the existing funding and investment strategies. And I mentioned, because the LGPS is funded, that investment strategy is important. So where's that money going to be invested? Is there a high allocation to asset classes such as equities, which are expected to generate a high level of return, but are more volatile than maybe an asset class such as bonds, for example, which may be less volatility but a lower level of return. So take all those inputs, put them through our models, the actuaries models, and then the key outputs we get I've got listed on the right hand side here. So just taking these key outputs into, firstly and primarily, LGPS funds realize that because the valuation is the point in time where employer contribution rates are assessed and then set for the following 3 years, employers are a really important group of stakeholders to engage with, and I think Simon's going to talk about that in his section about that. But typically all LGPS funds will communicate results to employers themselves via either an employer results schedule or via some other form of communication. So we'll let each employer know about their results of the valuation. There's also a document there about updated funding strategy statement, and I'll come on to discuss a little bit more about that in the next couple of slides. And then there's a final valuation report. So at the end of the valuation, there's a lot of discussions and documentation that goes on between an LGPS fund and the actuary as part of the valuation, but it's summarized in a final valuation report, which is then published publicly. So if you wanted to know about each individual LGPS fund's valuation, so the 2022 valuation, if you went on the Scheme Advisory Board's the LGPS Scheme Advisory Board's website, there is a place there where they've got all those valuation reports stored, and you can see them, and they can also be typically found on each LGPS fund's own website as well. So just focusing a bit more about those primary outputs from evaluation, if we could just go on to the next slide as well, please. So just on the left-hand side here, just a very high-level schematic. I showed a very high level how funds work in terms of funding. Delving down into a bit more details, this picture here shows on the right hand side in LGPS, really there's 3 sources of funding to pay all the members' benefits, both those that have been earned to date and those might be earned in the future. And that's the value of the assets that a fund holds today. And then there's the future, what the future may be. So future contributions, so employee and employer contributions, and future investment returns. Now, the 2 primary outputs that you may see reported around evaluation, if we take those 2 boxes on the right-hand side, start with the bottom one, the first one, funding level. And the funding level just looks at what's the ratio or comparison of the assets that an LGPS fund holds today versus the value or the estimated cost of all the benefits that have been accrued by members up to that date as well. That's sometimes referred to as the liabilities. And that funding level is really just a snapshot balance sheet view of the LGPS fund at that date. And what LGPS funds will do is work that out at each individual employer level as well. So the communicator funding level. Then they also communicate a contribution rate as a key output as well. And the contribution rate there is where does the balance lie between these 2 sources of future funding, with future investment returns and contributions. So you could have a strategy where the contributions are quite low, but that means that future investment return block needs to be quite high, and that may be quite risky because those future returns aren't guaranteed. Or you could have a strategy where contribution rates are quite high and future investment returns are quite low. So there's more certainty with that strategy, but it's not affordable for the employer. And so LGPS funds, when they're thinking about the funding strategy, be looking to strike a balance where that pink line is between that affordability versus stability and security there. And the important thing with the LGPS, member contribution rates, so the contributions paid by employees, is fixed. Those contribution rates are set out in line with legislation. They are tiered depending on a member's pay, but those tiers and the percentages of pay are fixed. Any change in the amount of contributions needed to fund the benefits in the future falls to the employer. It's known as a balance of cost pension scheme, so it falls to the employer to make that. So that's why employer contribution rates can change from one valuation to the other, depending on how the assets held today and what future investment return expectations, how those have changed from valuation to valuation and they come through to the employer contribution rates. If we just go into the next slide, if we think about those 2 key outputs, commonly it's talked about funding levels, normally talked at an LGPS fund level, an overall level. But in the LGPS, funding is carried out at an individual employer level. It's not done at fund level. So what each fund typically tends to do is look at all the constituent employers that make up the pension, the LGPS funds, because we have employers like councils, we have charities, housing associations, contractors, and obviously academy schools in there. And they look at each individual employer and assess each individual employer's own funding position. So calculate the funding level, and typically a contribution rate is set for each individual employer, and those can vary from employer to employer, depending on what your membership experience has been like, what your funding position is, how much money you paid in the past, for example. And really the aim is to avoid cross subsidies between employers. So each employer is only paying for the benefits in respect of their staff, instead of for some other unrelated employer there. And then when you see fund level results being reported, that's just really an aggregation, a sum of all the individual employer positions there. Now, if we just move on to the next slide, onto the final key output, which I talked about earlier in the funding strategy statement. This is a really important document. This is essentially the rule book for how an LGPS fund goes about achieving its funding objectives, how it goes about having enough money to pay members' benefits and manages its funding risks. Got set out here the areas typically covered by a funding strategy statement. And because at evaluation, the fund typically reviews its funding strategy, it will look at its FSS and it will update it. And under the LGPS regulations, it has to consult, if it makes any changes, it has to consult on those changes with employers. So during evaluation, as well as receiving some information about your valuation results that pertain to your own position in the pension fund, you'll probably receive an updated version of the funding strategy statement and ask for any comments you may have on that. And that should set out the approach that the fund is taking to set your contribution rates and fund your benefits and then manage key funding risk, a really important part of the governance framework. And again, that's typically a publicly available document on each LGPS fund's website. So that's a quick run through of the valuation basics, why we do it, how we carry them out, and the key outputs that come to you. If we just move on to the next section that I'm going to talk about, and that's about the market update and the current outlook for the 2025 valuation. So we'll just start with the market update first, so just on the next slide. And I'm obviously going to caveat and saying that we are currently in May 2024. The valuation date is until March 2025. Things can change, the environment can change. So please be aware of it. Funds will communicate with employers this type of information in the run up to the valuation, so you're aware. But if we just think about some of the key things that affect funding strategies and contribution rates for an LGPS fund, the chart on the left-hand side here just shows how the asset value for a typical LGPS fund has changed from the last valuation at 2022, when contribution rates were last set. There's been quite a bit of volatility, as you'd imagine, given what's been happening worldwide at the moment. But the growth in asset value has been broadly in line with expectations, generally since the last valuation. So nothing significant has different or outside expectations has gone on the value of the assets that the fund holds today. On the right-hand side, one thing that has changed has been the significant shift in the economic environment, and this is at a sort of a world level, not just within the UK, because LGPS funds are international investors. Some of the money is invested in UK asset classes, but they do invest globally. So we're trying to think what's happened globally here. And I've just tried to pictorially represent this change, such as the change in the value of long-term interest rates, which we're probably all aware of. And this economic change is a factor that funds are going to have to think about when they come to the next valuation, and think about, well, what does that change in economic environment mean to things like my future investment returns? If interest rates are higher, will I actually end up earning more money on all my invested assets? And if I earn more investment returns, earn more investment returns, then it places less pressure on contribution rates and the value of employer contribution rates. So going into this valuation, LGPS funds will be looking at that changing economic environment and thinking about, well, what does that mean? And if we just go into the next slide, taking that market update and trying to then put it into funding themes for the 2025 valuations. So currently actuaries are talking to funds and starting to think about this and putting plans in place for the next valuation. And one of the key themes is going to be managing surplus, and a surplus is where the value of the assets that we hold today is greater than what I think the value of benefits that need to be paid out. That funding level is over 100%. That ratio is over 100%. This is a good position to be in, to have surpluses, but it does require a bit of thought about how to manage those surpluses, how to manage the pace of any surplus distribution via reduced employer contribution rates. You know, how certain is that surplus? These surpluses can, because it's just a snapshot position, they can appear and then disappear very quickly. So thinking about the management for those. Funds need to think about how they deal with the level of uncertainty that's currently going on in the world at the moment around inflation, longevity, and future investment returns. So thinking about those key areas that may affect the future cost of benefits and how we fund them, and thinking, well, how do we manage that uncertainty and relate that to funding plans? And this idea of it's been quite a short, sharp shift in the economic environment. Thinking about, but LGPS funds need to think about the long term, because we're providing pensions for members that might not be paid for another 50, 60 years. So we need to think about how do we balance long-term stability. You don't want to chop and change and contribution rates and funding plans against short-term affordability, because aware of, obviously, employers don't want to be playing more than necessary into their LGPS fund, given that you've got other parts of other areas that you need to fund. So those, I think, the key themes coming up to the 2025 valuation, and that important point that I think funds will start communicating and discussing this with employers over the coming 12 months. Now, I think I've talked for long enough, and I think I'm just going to hand over to Simon, who's going to talk a bit more about employer engagement.
Thank you, Rob. And good afternoon, everyone. Hope you can all hear me. So yeah, as Rob said, I'm going to talk to you primarily today about employer engagement supported by the funds, and very much with the actuarial valuation as the background. So first of all, if we could just move forward a slide. Wanted to kind of talk to some of the context to do that engagement initially. So as Rob mentioned earlier on, there is a broad mix of employers across LGPS employer bases. And the majority of funds will have increased those employer numbers significantly over the last 10 years. So one of the challenges that comes with that growth is a recognition that one size doesn't necessarily fit all. And therefore, whilst we try our best to tailor engagement, it's very much a balance against the use of resource and time. The focus and needs of those employers might also be very different. So just to give you some examples, and some of these are cited on the screen. If we look at district councils, they may be relatively small in number, but they represent large volumes of members and with significant asset and liabilities. They also tend to be long established, run their own payrolls, and the LGPS is their sole form of pension provision. So accordingly, the focus there is more upon reminders and key deliverables when we're talking engagement. If I then switch to other groups, and using the education sector as an example, there is diversity within the education sector itself. So on one hand, we have larger higher education institutions, a number of which have participated within funds for a number of years. And then we might also, on the other side, we have academies, some of which might be relatively new to the LGPS. It is also a similar picture for our contractors, many of which will have contracts with academies themselves. And these combined with academies are the biggest areas of growth within LGPS funds. The difference contrasting those to councils is that across all of these groups, there are likely to be other forms of pension provisions, such as the university superannuation scheme, teachers' pension scheme, or even the social housing pension scheme. And for these employers, engagement may be as much about aiding understanding and awareness as it is those deliverables I mentioned earlier on. So moving on again, I just wanted to provide a bit of a reminder around the key touch points. And this is very much framed in the context of the next valuation, the 2025 valuation that Rob talked through. And just with a slight caveat that these are illustrative, and noting that a number of funds will operate different timelines and different levels of activity within each of these touch points. But I just wanted to give you a general feel of the level of engagement and that timeline. So the first is for data, and that is for data. For most funds, collect data on a monthly basis. So looking at the data up to the end of March needs to be provided to funds by the 19th of April. Then throughout the summer, there will be a focus on initial engagement, assumption setting, and the issuing of those provisional results that Rob mentioned earlier. So a first set of results which employers are able to look through and understand in the context of their own budgets. Then we tend to find beyond the summer, there's more all employer engagement sessions. So that's again grouping all the employer groups together. And then towards the end, it tends to embark on more one-to-one discussions. So for those employers who wish to have a direct conversation with the fund, there's an opportunity to do so ahead of the funding strategy statement consultation opening, which is later on in the winter. And this window is really important because between the provisional results and the closing of the funding strategy statement consultation, that is really your opportunity to engage ahead of those final results being issued and the new contribution rates becoming effective from the following April. So I'd really encourage you to engage with funds during that window where possible. Moving on again, I just thought it was worth recapping the role of the employer and expectations from the fund. And again, these are relatively generic and apply across all employers, but there are nonetheless some specifics for academies within here. So some of the key areas are to firstly engage, so to ensure you are meeting your responsibilities under the pensions administration strategy. So the vast majority of LGPS funds will have a pensions administration strategy, and that sets out the key roles and responsibilities for each employer, as well as the fund's responsibilities back to those employers. And where possible, I would encourage attendance of briefing sessions facilitated by either the fund or the fund actuary, and a review of the related material issued by the fund, whilst also recognising that for many of you, pensions probably forms a very small part of your day-to-day business. So we recognise the diverse nature of the things you need to deal with. As I'm going to come on to, data is very much critical, and with opportunities for you to check the data upon which your contributions are derived. So when you receive those provisional results schedules, within there you should have a summary of the membership of your employer base and the membership on which the fund actuary is basing their calculations. So an opportunity to check that and test it back with the fund. The next element would be to respond to both the funding strategy statement consultation and in many cases the investment strategy statement consultation, where those are released by funds. And those are really, as I said earlier, an opportunity for you to have dialogue with the fund around the strategies that are being implemented, which ultimately will shape the contributions which are implemented at the end of the cycle. And then finally, touching upon employer covenant. So I'd anticipate now that most funds view academies as low risk, given the reinforcing of the Department of Education guarantee. However, if that does not materialise in practice, there is an opportunity for you to engage with those funds on that subject. All funds will be probably talking to their employees about employer covenant, so that's your window to engage with them on that subject. Moving on again, there are a few other matters that you may wish to consider, and I'm just going to touch on 4 of these, but there are no doubt a host of other ones which you might want to work through with your fund. The first of those are outsourcing arrangements. So in line with the recently issued LGPS good practice guidance, which is going to be touched upon later on in the slides today, for the Department of Education guarantee to apply to contracts outsourced by an academy, such as those you might outsource for catering or cleaning, academy trusts must enter into a pass-through arrangement for all employees who remain eligible to access the LGPS. This should mean by nature that the contribution rates for those contractors are set at the same level as those for the academy trust. However, you may wish to confirm that with the relevant fund and ensure that those two things are aligned. Similarly, you might want to engage with your fund on pooling options. So this may include pooling of primary and secondary contributions at multi-academy trust level or across all academies. So it may be that some funds group all academies together and pool the rates across all of those academies. And when considering pooling across academies, there will naturally, across all academies, there'll naturally be winners and losers. So again, it might be important to understand the implications and engage the fund on that basis. As I mentioned before, there are options around those pooling of contribution rates and potentially in terms of timing. So one of the things you might want to engage with funds on are contributions and timing of contributions. Some funds may allow some flexibility around the timing of those contributions, particularly when it comes to secondary rates, in that they may be spread over a year or conversely collected at one point during the year. And then finally, some funds may offer ill health insurance arrangements. So what I mean by this is when a member goes on ill health retirement, that creates a greater liability strain because the member is taking an enhanced level of benefits earlier on. For some of those liabilities, some funds will offer arrangements which pool that risk across groups of employers, kind of a captive insurance arrangement within the fund. Equally, there are also external insurance arrangements in operation through some funds. So again, an opportunity for you to engage with those funds and understand those potential pooling arrangements or those potential ill health insurance arrangements. Skipping on again, if I may. So here what I'm going to talk to you is very much the importance of data. So when Rob covered the inputs to the valuation at the start, one of the key inputs is data. And just to draw out why this is so important, what you'll see from this chart is there are a variety of different data elements. So it might be membership, cash flow, or things around individual employer circumstances. All of those are really important to funds to collect at the start and share with the fund actuary. Those will then shape the calculations around the liabilities themselves, the assets, and also the funding strategy considerations that the funds will work with the fund actuary upon in terms of setting contributions. So the final output, as Rob touched on earlier, is once we've collected all those things together, the data very much underpins the contributions which emerge from the valuation. So really, really important that where you can cleanse data now ahead of the valuation, I'd urge you to do so, and also to work with those funds as they work through the data and release provisional results. Just to illustrate the importance of data in a more granular form, if I move on to the next slide, what this shows here is the impact of incorrect data and just pulls out a couple of real life case studies or examples. So looking at the one on the left, what this is an example of where the full-time equivalent salary, a number or a digit, is transposed in sharing the data with the fund. So what you can see here is the same member who might have had a salary of £10,500. If that's recorded as £15,000 by error, the impact on the liability is significant, a 50% increase on that individual member liability. And of course, if that happens multiple times across membership, that will be incremental in the impact. Similarly, looking at date of birth, again, a switch of date of birth, just a 9-year difference. So having, instead of being born in 1956, an error occurs, it's recorded as 1965. That has a 51% impact on the resulting liability. So hopefully that illustrates the real significant impact of incorrect data. again, if I can just skip on. So just a final reminder of some of the things that both Rob and I have covered in terms of what you need to do ahead of the or during the next valuation. So the first point is to read very carefully the results schedules that I shared with you. The provisional one will be the first one, which gives you an opportunity to check the data and to engage with the fund. And then that will inform the final results schedule, which sets your contributions and those that come into payment. I'd really encourage you to review the funding strategy statement. That will capture that individual's funds strategy to shape contributions. It will cover a number of the elements I touched upon today, such as ill health insurance, pooling of contributions. All of those things will be formed into there. As Rob said, that is really the rule book in setting contributions. And then finally, engage with the funds. So talk to them when needed and ask questions. And then just before I pass on, I was going to briefly spend a bit of time, if I can move on to the next slide, talking about the difference between a funding valuation and an accounting valuation. So just skipping on again. What you have here is a table which sets out the key changes. So we very much focused on funding valuations today, the triennial valuation, the next of which will be in 2025, but also very cognizant that you have your own accounting standards and you include these in your own accounts every year. So there's a significant difference between those valuations and how they're carried out. The main difference, I suppose, to draw out is that the FRS 102 or the annual accounting standards are based on a prescribed set of standards, prescribed set of assumptions, which are the responsibility of the employer in consultation with their auditor. The funding strategy, the funding valuations are what we've described today. So those are setting your contributions, and they will use very different assumptions. The key one probably being the discount rate. So we've drawn out the differences here on this slide, but what you will notice is for FRS 102, the discount rate will be lower, which is placing a lesser reliance on future investment returns. They'll also use different data cuts. So the funding valuations will be based on actual data. The FRS 102 is based on a roll forward from the last valuation, so it won't reflect the actual membership of that institution. And then again, differences in timing, which are probably obvious, the ones being around annual accounting, the other being around that triennial submission. So at that point, I'm going to hand on to Richard. Thank you for your time. Thank you.
Thank you, Simon, and good afternoon, colleagues. I'm Richard Lane from Twyford Church of England Academies Trust, and I'm going to talk about new developments in best practice when it comes to Academies' dealings with the local government pension fund. Next slide, please. An LGPS working group was formed last year, and it operates under the umbrella of the Academies Finance and Assurance Steering Group. This is the forum that oversees 4 committees dealing with different aspects of the ESFA's financial oversight of the sector and includes Academy representatives. The LGPS working group's main purpose is to promote best practice, and the LGPS Good Practice Guide that was published last month on the .gov website was the first fruits of its work. It's the latest addition to a growing library of good practice guides that you're probably familiar with. You can find them by Googling Academy Good Practice Guides. They're useful resources for trustees as well. Another priority of the group is improving things for MATs that work with more than one fund, also known as multi-fund academy trusts. We're currently looking into what can be done to streamline processes for these trusts by creating standard templates for pass-through arrangements and similar improvements to systems. And the next slide, please. The content of the Good Practice Guide was informed by feedback from the last Power Hour, which was last year, and includes information about valuations, which we've heard a little bit about today, including the 2 different types of valuation, It includes information about contribution rates. Again, some of what we've heard about today and going into a little bit more detail. Conversions and transfers, and also the DFE's guarantee, again, which has been covered earlier by Simon, and the guarantee that extends to contracted out services, and also pooling and the wide range of different types of pooling arrangements that there are. So if you've got particular questions and queries about those kind of things, I would strongly advise you to look at the Good Practice Guide, and you will find quite a lot of detail in there. And as Simon was saying, the 2025 valuation is a good opportunity to review any pooling arrangements that you have. The LGPS Good Practice Guide is very much phase one of a larger exercise that the working group is undertaking. And Charity is now going to talk a little bit more about what happens next. Over to you, Charity.
Thank you, Richard. Just to say, as Richard said, that phase one is very much the kind of start of the development of this guidance. So please do provide feedback on that guidance. You'll see on the screen there's an email address that you can send questions and feedback on, so that the working group can consider that as part of its work. Please note that accounts only to gather feedback and to support us as a working group. It isn't to answer specific academy questions that you should route through the customer help portal in the normal way. In terms of kind of next steps for that guidance, we have some initial ideas about things that we think might be useful to cover. So one area is data management. So we've heard this afternoon how important the quality of data is, but we recognise that handling data is quite complex, depending on the method that your fund uses. So we're interested to explore what guidance we might be able to provide in that area. Another key area that we're looking at is pension discretions. So it's a requirement of your LGPS fund generally that you have a pension discretion policy, which sets out your approach in certain circumstances. So, for example, it might talk about time limits for members to undertake certain actions, or it might talk about where you might exercise discretions in terms of certain aspects of retirement, for example. So again, we're keen to explore explaining what a discretion policy is to support academy trusts better in engaging with those discretion policies. There's also then on the slide a kind of another group of areas that we're keen to explore, just in terms of the life cycle of an academy. So that's in terms of establishing academies, bringing academies together, so transfers between trusts, and establishment of sort of wider groups. So that's another area that we are hoping to look at as part of phase two of the guidance. But as I've said, really we want to hear your views, so please do let us know what you'd like us to consider in that guidance. If I could just have the next slide. The other thing that we thought would be useful to do would just to be summarise some of the other guidance that's available in respect of LGPS pensions, and just really to emphasise the volume of work that is sort of going on in the area. So there's a couple of areas here where things have been published and a couple of areas where work is ongoing. So in terms of the first piece of guidance that's been published, Rob talked a bit in his presentation about funding levels and the fact that some funding levels are above 100% at the moment, so the value of the assets exceeds the value of the liabilities. And the Scheme Advisory Board, so that's the LGPS board that sort of oversees, provides guidance to all the LGPS funds in the country, published a guidance note on surpluses in December 2023. So you might want to look at that guidance note. And that really reflects the fact that a funding surplus is not a cash surplus, but does explore possible opportunities to use surpluses to lower employer contributions, and talks about the need for or talks about how funds might engage with all employers, including academies, in respect of funding surpluses. The second piece of guidance that was published a little bit earlier in 2023 was some guidance around academy conversions. And again, there's a link to where that guidance can be found, but it's on the Scheme Advisory Board website. And that was really following a recommendation of the Government Actuaries Department about needing to explain how approaches to sharing assets and liabilities on academy conversion. So what that guidance does is it tries to establish a common terminology. It includes some worked examples, and again, it should make academy trusts, or it should give academy trusts some information that allows them perhaps to talk to their LGPS fund about the approach that's been taken in respect of their academy conversion. In terms of ongoing work, there's sort of two big pieces of ongoing work at the moment. The first there is badged as information sharing guidance, and that's a big piece of work that's a collaboration between the Local Government Pension Scheme Advisory Board, auditors, actuaries and employers on which academy trusts are represented. And that's just around providing guidance to support people to communicate better and to understand how the audit process works. So that's very much a piece of sort of ongoing development. There's a draft document that's currently being considered, and we expect that to be published in due course, and we'll be able to provide links to that. The other piece of work that's been ongoing links to as Rob said, one of the key outputs of the triennial valuation and the process and the rule book for LGPS, if you like, and that's the funding strategy statement of your LGPS fund. And again, the sector has representation on the group that's looking at the guidance in terms of pension fund funding strategy statements to make sure that they are fit for purpose and that they support the needs of academy trusts as employers. So that's all I had to say. So I'll pass back to Jamie.
Thanks, Charity, and for all our other speakers today. You may have seen in the Q&A we've answered some of the questions that have popped up with links to guidance and answers there. We've also got a couple of questions that I'm going to run through now quickly, particularly as we've got Rob and Simon on the line. So first question that I'm going to ask Simon is, and the question was, at the moment we're in a credit for a change. Why can't we withdraw the funds?
Yeah, really good question. I'll start with the regulatory framework and then I'll elaborate a little bit further. So to begin with, contributions, when they're set, they are in the rates and adjustment certificate published by the fund actuary in the valuation report, and those set the contributions for the forthcoming 3 years. So they're on that certificate. It's probably also worth drawing out that even if the position were to worsen, so we were to go backwards the opposite direction into deficit more so, the funds wouldn't still seek to redress the contributions during that intervening period. The only variance on that is there's something called employer flexibilities within the the LGPS regulations. What that enables is an employer to approach a fund or for a fund to carry out a review based on a significant shift in either covenant or liabilities. Charity touched upon the LGPS Scheme Advisory Board guidance, and within that guidance it specifies that that shift in liabilities shouldn't be it shouldn't be based on the measurement of those liabilities. Rather, it should be underpinned by significant membership changes. So what we're seeing in the LGPS in general, which Rob alluded to in that market update, is a change in the measurement of the liabilities. We're not seeing, there may be some employers where they're seeing a significant shift in those membership, in which case they could trigger review on those grounds. But the general shift in terms of market movement wouldn't necessitate a review of contributions in itself. So what most funds will be doing, to answer the question, Jamie, is they'll be looking forward to next valuation, 2025 valuation, very much considering potential for contribution reductions alongside things such as de-risking and locking in some of those gains at that point in time.
Excellent. Thanks, Simon. And the second question we've got, it's for Rob this time. So the question was, my trust's LGPS liability reduced from 21-22 in 22-23 valuation. If the same valuation is repeated, it may put us in an LGPS surplus position. What will the impact of having a surplus LGPS be for us?
Okay, a couple of things maybe to unpick there. Just given the dates of the dates in the question there, that suggests maybe we're looking at the annual accounting report, because we only carry out evaluation 3 years, so 22 and 25. Just in terms of focusing about annual accounting first, Simon touched on, discussed this at the end of his. That's very much just for the purpose of putting in annual report and accounts. The position is not related to your true funding position that sets contribution rates in the fund. So that impact of a surplus that you're seeing there would be for accounting. But taking the point a bit wider, and we've talked a bit about funding positions potentially being surplus, and just picking up on what Simon mentioned at the end of his response to the first question there. Coming into the 2025 triennial formal valuation where rates are being set, if employers remain in surplus, funds will be looking at essentially 3 things you can do with surplus broadly. And that is reduce contributions. If you have more money than you used to have in the past, then maybe the employer contribution rates can come down. You could look at changing the investment strategy. You might not need as much growth from your investments because the surplus helps reduce the pressure on there. So you could maybe change the investment strategy. Typically think about de-risking. So take out some of that growth, but also take out some of that volatility and that gives more longer term stable contribution rates, which is beneficial for employers, or potentially put a bit more prudence into the funding plans. And the idea again behind that is almost think of it as like a rainy day, using some of that surplus as a rainy day fund to manage any future volatility or future adverse situations that the fund may find itself in because of the wider economic environment it operates in. What will typically probably happen is funds will think about using a combination of all 3 of those. And again, it's this idea of balancing affordability for employers against that long-term stability point. Academy schools are in the LGPS for the long term, so we don't want to make knee-jerk reactions because then whilst you might like a knee-jerk, like a large reduction in contribution rate, you won't appreciate it. There has to be a knee-jerk upward increase in contribution rate in the future. It's trying to smooth out those changes in contribution rates over time. So funds will typically, I'd expect, as part of the 25 valuation, communicate what they're thinking about in that space of surplus and how they're going to use it.
Thanks, Rob. That's excellent. I think we've got time for one more question. So we just had one pop up, which I'll go through. I think, Charity, if you could answer this one if possible. So our trust have an annual panic when they see the LGPS deficit on the audited accounts. What should I tell them to reassure them about the liability?
Thank you, Jamie. So as a Chief Finance Officer, I'm used to having to explain to trustees and again, what's this large liability in our annual accounts. I think the first thing I would say going back to Rob and Simon's points, is this difference between the accounting valuation and the triennial valuation. And the accounting valuation is an accounting valuation at a point in time. It doesn't score against your usable reserves. It's an accounting entry. The valuation that matters in terms of what happens in terms of your annual revenue flows is that triennial revaluation. So it's really that valuation, if anything, that trustees should be concerned about, I think, rather than the accounting valuation. So we've talked today about the sorts of inputs that are important in terms of that triennial valuation. And you can find more guidance that might actually support your conversations with trustees in the good practice guide that we reference. So that's not only a guide that's probably useful for you as practitioners, but it may also be useful for your trustees.
Excellent. Thanks, Charity. I think we're very nearly at the end of the time for the session today, so I'll look to draw it to a conclusion there. But just to say a huge thank you to Charity, Richard, Rob and Simon for their contributions today. It's been really useful. I think hearing from practitioners within the academy sector and the pension LGPS sector as well has been really valuable. So I'll just draw listeners' attention to the Q&A where we've answered some of the questions, and particularly the best practice guide that we published as well, and other information on the Scheme Advisory Board. And once more to urge you to complete the feedback. That's really helpful to us to inform future sessions as well. So thanks all. Hope you have a good day, and we'll see you again soon.
Thank you.